All right. Well, we'll go ahead and get started. Thank you all for joining us today for Sparking the Change, Trends Impacting Nonprofit Success in 2024. I'm Annie Deer, and I will moderate our presentation today. So before we get started, I have a few quick housekeeping items to cover. If you have any questions today, we encourage you to submit them throughout our discussion using the question box at the bottom of your screen. And when we conclude today's prepared remarks, we will spend our remaining time answering the questions that have been submitted. And if we are unable to get to your question, we will personally follow up with you after the event. For your convenience, a recording of this event will be available on our website within the next several business days. Now, let me introduce today's speakers. First, we have Nick Centineo. Nick is a senior investment consultant and endowment and foundation service lead at Manning & Napier. Nick's expertise is in planning as he works directly with nonprofits, helping with objective setting, cash flow analysis, asset allocation, fundraising strategy, and charitable giving. Margaret Jeffries is a wealth management consultant, delivering a broad range of financial planning services to our clients. Margaret's expertise comes from the donor perspective, as she helps many clients who are also donors to develop strategies to meet their near and long-term charitable giving and tax and estate planning goals. Paul Stanzione is a portfolio strategist and is responsible for communicating Manning & Napier's philosophy, processes, and portfolio positioning. Paul's expertise is in investments and understanding markets, so he can provide insight into how both of those affect your donors' portfolios as well as your organization's portfolio. So today's discussion is going to center around some of the top questions that we've received from our nonprofit clients and partners over the last year. And as we dive into these questions, it's our goal to provide some insight and share ideas and key trends that will help spark the change and keep your organization moving into the year ahead. The first trend that we've identified is that 2024 is going to be the year for donors to be more planning focused. So we'll delve into that a little more in depth later on, but there are a lot of factors at play here, and there are ways that you can take advantage of their planning. The second is that nonprofits can utilize endowments as a stabilizer amidst an uncertain market. So if there's one thing for certain, it's that we are living in a world of uncertainty, and we'll discuss how an endowment can help your organization weather any storm that might come your way. And the third is that economic conditions and market opportunities have been reset by higher interest rates. So to better understand what lies ahead, let's talk about how we got here. Paul, do you want to kick us off and talk about what happened in 2023 to get us to where we are today?
Yeah, absolutely. Thanks, Annie. What I would say stuck out most about last year was really how, in terms of the economy and markets, that perception seemed to not match reality very closely. And this is somewhat representative of a broader phenomenon that we've been experiencing with this growing disconnect between impressions that people have about how things are going and what the broader reality is, or even what their own actual experiences would suggest. Last year was a really poignant example of this. You know, the economy was very resilient, much more so than many expected coming into the year. Unemployment remained very low, wages grew, and inflation moderated significantly. So that's the makeup of a pretty good economy right there. And yet that wasn't necessarily the sentiment for much of the country for various reasons. Probably chief among them the fact that while inflation came way down from an economist perspective, that didn't mean prices actually came down. So those are two very different things, and consumers, investors, donors, they all continued to feel, you know, that squeeze of persistently higher prices last year. And that takes some getting used to, whether it be at the grocery store or in buying a home or what have you. And So where does that bring us to today? Well, after last year, what I would call the most anticipated recession in history that never happened, views are a lot different going into this year. There's a lot more collective optimism that recession has been successfully avoided. The war against inflation is over. The Fed is going to be able to bring down interest rates quite a bit against that rosy backdrop. And things are generally positive from sort of a consensus outlook perspective. We don't necessarily agree that it's going to be that easy or simple. Um, we still see a meaningful degree of elevated risk in the economy that we don't think has fully shaken out yet, especially for a lot of businesses that are facing a tighter credit environment, and for consumers as well that we think are unlikely to be able to keep up the pace of spending that we've seen for the past couple of years, especially if the employment market and the labor market starts to soften a little bit, which we think is likely to happen. So we don't think we're quite out of the woods yet. And so our advice to that would be to just not become overly comfortable at this point, expecting inflation and risk to be fully behind us. But rather we would say, continue to see the value in planning and preparation for at least the possibility of more challenging economic conditions ahead of us.
Yeah, I'll jump in there, from a planning perspective. To me, the story in 2023 was rates. And by that I mean, what nonprofits can earn on cash and bonds. Um, interest rates are literally an input into just about every one of the planning assumptions that nonprofits have to make. So from portfolio returns to inflation, as Paul mentioned, to donor capacity. We actually dedicate a question sort of on how rates impact all these things, so I won't spoil the surprise. But for now, definitely the biggest story last year was shifting rates and yields, and how that's set up organizations for difference going forward. So for some context, 3-month T-bills, super short holdings. They started last year at about 4.5%. They ended the year at about 5.4%. So up quite a bit. 10-year Treasury bonds, much more longer term. They started last year at 3.8%. They got to nearly 5% in October before coming back down to just about where they started at about 3.8 or 3.9% at the end of the year. So it's been kind of a wild ride in terms of the direction of interest rates, especially on the long end. Inflation has been the number one factor, I think, behind these moves. Or I guess, more precisely, it's the investors' expectations for what the Fed will do to combat inflation. And so short rates are closely tied to the Fed funds, but longer bond yields, those align with longer term expectations for all these things. And so, last summer you might have heard the term higher for longer. There was worry that the Fed would have to keep short rates higher for longer because of inflation. And that drove up bond yields. And that's when 10-year bonds briefly touched 5% for the first time in 15 years. And then in late fall, this all reversed. It looked like inflation was becoming more manageable. Bond yields fell rapidly, prices rose, and stocks did great. And so you can see where investors have been hyper focused on inflation and rates. And that's led us to today, where you can earn a pretty good return on cash, and I would say a pretty decent return on bonds too. Though we think that type of volatility, that type of the type of volatility that we saw in 2023 in rates will continue.
All right, so now it's time for our first poll. So we encourage you all to answer either agree or disagree. It will be better to spend less from our endowment going forward because of challenging market conditions. Agree or disagree? Right. Well, it looks like we are dead even here. And while this, either answer could be true, the
Yeah, Annie, I was going to say that that's a good thing because I think either answer could be true.
yeah. The practical answer lies in the goals and spendings and needs of your organization. So volatile markets will impact every investor type, and it's in the planning and investment management process that really dictates the best ways for you to utilize your assets. Paul, can you expand on what organizations should be thinking about from an investment perspective? Specifically, are we being complacent with our investment approach?
Yeah, I think I would emphasize a couple things here. One being that it's always really important to distinguish between complacency and consistency. Those two things can look very similar, but have very different outcomes. Not being complacent to me means having flexibility within, the broader context of a consistent plan and investment approach. At the same time, without overreacting to a given environment or straying, from the organization's ultimate goals and objectives. One example to illustrate what I mean is, say a board is really excited about the prospect of 5% yields that they can earn on short-term bonds right now, 6-month treasury bills. And this is a specific conversation that we've had with a lot of clients over the past year or so. So I think it's a good current example to point to. But say a board sees these yields and thinks we can effectively take zero risk with our assets and earn 5% a year. That sounds pretty awesome in a lot of ways. So to me, being complacent in this situation would be ignoring this new opportunity, this new market dynamic. We don't think that would be prudent as a fiduciary to sort of not adjust or try to take advantage of this new opportunity that presented itself over the last couple of years in the market and has reset this interest rate environment to really change the landscape of what it means to make investment and asset allocation decisions right now. At the other end of the spectrum, I think being overly reactive would be, taking, say, what was a balanced portfolio with an objective of, being able to support the organization right now, but ultimately grow those assets over the long term to support the organization into perpetuity. And, if a board were to move all or a large portion of those assets into short-term bonds to earn 5%, that might feel pretty good for a little while and, make the board feel comfortable or the investment committee feel comfortable about effectively completely de-risking the portfolio and still making 5%. But that's not going to meet the organization's long-term goals and objectives. It's a short-term fix, if you will, or solution that is not conducive to sort of reaching long-term goals. So the sweet spot, I think, is where you have some controlled flexibility. I think that would be for a manager to take advantage of today's higher interest rates, but in a coordinated fashion, while all at the same time never losing sight of the bigger picture and the long-term objectives of the organization. So we want to be able to take advantage of what the market gives us, but at the same time, always maintain that level of consistency that sets us up for long-term success.
Yeah, that question that we had, I think it's a good example. It's sort of a trick question, but I think it's a good example of like a what if question, which I think is really important today. I think, so I'll give you an example of what I mean. So I define complacency as just the failure to think critically about your status quo. It doesn't mean you have to change things just for the sake of it. A good plan shouldn't really change that often, but it should be constantly tested to current conditions, like Paul was mentioning. And we've already talked about how much those conditions can shift over time. And so because of this, one of the most important things nonprofits can ask themselves today are those what if questions. And that was an example. And so others would be, what if we are too conservative in our investment policy or too aggressive? Or what if there's a large drop in the market? Or what if inflation is higher than expected? Or again, yeah, what if we want to spend more or less from our portfolio? From my perspective, it's really all about using an analytical approach to answering questions like this. So let's talk about that approach. So let's start with a base case projection, make some assumptions about returns, volatility, spending, inflation, and contributions if you're fundraising. Start with where you are today, and then model out where you want to be, where you might be 10 years from now, but include a range of future possibilities for mostly for things that are outside your direct control, like what the market does. And you should be looking at both good and bad scenarios, for things that are outside of your control. And so next, after you have that base case, you can answer these what if questions by adjusting your assumptions, right? Your spending rule, your allocation guidelines, your contributions into the portfolio. You can test these what if questions, or you can stress test your portfolio by forcing on your projection some sort of adverse situation, like a bear market, for example. And then you evaluate what that does to your long-term outcomes. And as far as actually doing the analytical work, if you're on the board or staff, you don't really have to worry about that. That's usually not your job. That's our job. In fact, we help our clients analyze their portfolio in just this way. And we'd always be happy to help all of you on this call. You just have to let us know. But it is your job to use this information to make informed decisions. You do have a fiduciary duty to prudently manage these portfolios, and yeah, you have tools at your disposal to do just that. And so that's an important thing to be asking yourself today.
Yeah, and I will say it's the exact same thing for your donors. So we're just like you guys are looking at the nonprofits portfolios, taking all of these different factors into consideration, running all of those different what if we need to spend more on a certain project or something like that. I'm also doing the same thing for our donors. And I think this is really helpful for the nonprofit side, because we see what, a donor's ability to give is, or their inability in harder environments. So we are running those same exact, spending, cash flow projections over long term. We have a lot of tools. So I think it's important both on the nonprofit side as well as for the individual donors.
All right, let's keep things rolling with another poll. Higher interest rates negatively affect a donor's capacity to give. Agree or disagree?
I think our audience is spot on today.
Yes, I love the split answers. It's really interesting because again, it could go both ways. Donor capacity is influenced by a number of factors, ranging from supporting causes important to them to being financially strategic, and there is no one area that's siloed from the rest, whether that's inflation, high interest rates, market volatility, a recession. All of that will, to some degree, impact your donor's confidence and capacity to give. So let's go to Margaret to share your perspective on the impact of higher interest rates.
Yeah, I kind of feel bad that we're throwing all the trick questions out, because the answer today is really that, each donor is going to be impacted differently. Their situations are different. So it's a mixed bag. It's right now a much better time to be a saver in higher interest rate environments. You have the flexibility, as Paul and Nick kind of touched on, about investing in some of those shorter term bonds, but still getting a high return for that. So they're not as worried about meeting their nearer term, spending needs, and which could include donations. That's generally our older clients who are the savers, right? They're not the ones that have extreme cash flow needs or big purchases that they're expecting. The younger donors may be having a harder time, though, the ones that are looking to buy, houses or finance a new car, those large purchases that now all of a sudden they're looking at much higher interest rates, a higher cost to do that. So their, day-to-day cash flows might be a little bit more strained. And that kind of also has a trickle down effect, actually, as I've been seeing here with our clients, is that when kids don't want to spend a lot more money on interest by taking out a loan, they tend to go to the bank of mom and dad. So those older clients that they themselves may not really be needing to make those large purchases, I have been seeing more donors, my clients, the high net worth individuals, coming to me looking to take withdrawals to then give to their kids for purchases. So it really is kind of a mixed bag of what's happening in the short term about capacity to give. But in longer term, I think that it really hasn't impacted many donors' capacity to give, and I'll kind of touch more on that a little bit later. But basically, what it will be changing is more how we're advising them to give. So, are you giving cash? Are you giving in-kind stocks? Are you funding trusts? How do we actually go about making those donations?
Yeah, again, on the planning side, interest rates impact just about every aspect of planning for an endowment. And there's some obvious ways, there's some not so obvious ways, some surprising ways. And part of that planning is, accounting for what donors will do too. So I think those are all great points that Margaret made. But let's talk about an endowment's investments first. So for cash and bonds, the impact is pretty straightforward. As yields rise, it can make for a bumpy ride on your existing holdings, because prices on bonds fall when yields rise. But after that, higher yields make bonds much more attractive. So yield is a pretty good estimate of your expected future return. Actually, it will be your future return if you hold a bond to maturity and it doesn't default. So whereas a 10-year treasury yielded less than 2% 2 years ago, they currently yield closer to 4%. And so we're not quite back to historical averages either. 5% on a 10-year bond is historically considered about average, but we are in a much better position than 2 years ago. So that's just some context on the bond side. The relationship between stocks and interest rates is more complex, I think. There's been times when higher rates have coincided with great stock returns. Pre-year 2000 is a good example of this. There's been times when lower rates coincided with great stock returns too. You just have to go back to the 2010s, I think, to see an example of sort of that dynamic. Statistically, one way to measure this relationship is by looking at the correlation between stocks and bonds. Prior to 2000, the correlation was largely positive. Stocks and bonds moved in the same direction a lot of the time. After 2000, correlations were mostly negative. Stocks and bonds often moved in opposite directions most of the time. And then in the last 2 years, correlation has rapidly shifted to be positive again. Stocks and bonds both tanked in 2022, and then they did very well last year at the same time. So this relationship is an interesting one. It's largely driven by, I think, what signals investors are perceiving from those interest rate moves. What does rates moving have to do with the fundamentals of a stock or the economy? If higher rates are reflecting a strong economy, and the economy can tolerate some sort of a normal cost of capital, that's generally a good thing for stocks. It was in the 1990s. But if yields rise because, again, let's say central banks are battling inflation, that could be a bad thing for stocks. Bonds might not provide as much of a cushion as we've been used to if a downturn occurs in that case. That's what happened in 2022. And I think it's still a definite risk today. So there's all these dynamics, and they affect your donors as well. You know, all of these, you know, Margaret mentioned examples of how rates sort of impact your donors' planning, but these same investment dynamics affect your donors' portfolios as well. I'll just say that, you know, for anyone that feels reticent, I think most fundraisers would say it's never a bad time to stop asking. Gifts are still primarily made based on emotion, right? So it's always a good idea to cultivate those relationships and discover, you know, what emotions are moving donors. But changing interest rates can affect the timing of those donations. It can affect the capacity of those ultimate donations. It can affect the method by which donations are made. And so we have been doing a lot of that education and you know, meetings of donors and fundraisers together to share ideas about how these changes have been happening. And so we like to let all of our clients and our organizations that we work with know about that as well.
Yeah, I would just put a bow on the interest rate discussion, you know, with the point that a higher interest rate regime that we've entered into, you know, it provides really one of the strongest reasons for having an endowment in the first place. You know, when it's very similar dynamic to what Margaret described with individuals and donors. When rates are high, it's far more advantageous to be a net saver than a net spender. And so having an endowment to rely on, you know, it can allow an organization not only to avoid having to borrow money at those higher rates to fund their operations or growth or initiatives or what have you, but also theoretically earn those higher rates on their endowment assets that they don't need to spend in the near term. So there really is that double-sided benefit to having that endowment in place and that support that you can fall back on, regardless of interest rate moves and interest rate environment, to be able to navigate those changing conditions as an organization.
So we touched on how it can really be a mixed bag when it comes to higher interest rates affecting donors, because it really depends on their unique situation. So what is the likelihood that giving will actually slow this year?
So I'll take this. In general, I mean, larger donors that want to give, they're gonna keep giving. So the donors that I work with directly, you know, their plans are still really on track. You know, we touched on how I run out cash flow projections, spending, growth projections, and really those are all still on track. We model in the donations, you know, both like the smaller donations year to year. We also model in, you know, larger donations. So what I've been finding is that, you know, people are still, the retirees are still going to be subject to those required minimum distributions, RMDs, out of their IRAs, which I think is a great funding source to encourage donors to give out of. And that's going to be a consistent amount, hopefully. It is impacted by returns a bit, but, you know, that's going to be a consistent source for them to give out of every year. And then we also have this upcoming planned sunset of the Tax Cuts and Jobs Act, which right now it's doubling the estate tax exemption for our ultra high net worth clients. This is, you know, probably meaning that very few donors will actually be subject to estate taxes. But the sunset that's scheduled to occur in 2026 would cut that exemption in half. So there's going to be a slightly, you know, bigger number. So it's about $7 million per person it'll go down to. We are in discussions with our ultra high net worth clients right now to, you know, start positioning themselves to be able to take advantage of that higher exemption. This means funding trusts for kids or for charities. So the likelihood that giving actually will slow down, I think it actually will stay pretty steady this year, and you may actually see an uptick of people looking to make those longer term commitments, such as a charitable remainder trust, because in 2024 and 2025, because of that upcoming sunset. And I brought up a charitable remainder trust specifically because those are also really good to fund for donors in higher interest rate environments, because the Fed lets you use a higher like crediting rate or assumed growth rate for those assets. So the assets will be left to charity at the end. There's an upfront income stream to the donor, and then whatever's left goes to charity. So if it's assumed that this bucket of money put into the charitable trust is going to grow really fast because of a high crediting rate, more is going to go to the charity. And it means also that donors can deduct more of that upfront donation right on their income taxes for the current year. So these are kind of some of the things that I'm talking to clients right now. There's still a lot of strategies that we're going over.
A lot of friends of Manning Napier, people who are fundraising professionals, you know, who deal with donors, they think it's a real possibility that donations will continue to slow. 2022 was a down year for giving. We know that 2023 might have been. The Giving USA numbers come out mid-year, so we'll see. It's possible that 24 will be another difficult year. Not a sure thing, but it's a risk. The biggest determinant is probably still the stock market, right? So you just can't predict that from year to year. But inflation has really put a damper on donors. And I think we've sort of forgotten how consumer psychology is so closely tied to prices. And Paul touched on this a little bit, but know that inflation has gotten a lot better. The latest annualized readings, the monthly annualized readings are well under 2%, but prices are still high relative to people's expectations and their capacity to pay. And so that is a way of muddling charitable plans, I think, muddling how people do that planning that Margaret was mentioning. So I don't have a prediction on whether it's going to be an up or down year. 1 year is too short of a time period to predict anyways, but it's a real possibility, and organizations should prepare. Your endowment is one of the best ways to prepare. An endowment is a stabilizer. It's ballast to complement other sources of revenue. Organizations that have a robust endowment clearly have an advantage. For those that don't, it's never too late to start one. And so it's a good investment to make today, to be thinking about the infrastructure needed to accept gifts and cultivate legacy donors, because work done today will pay off the next time we're in a difficult fundraising year.
So to take everything we just talked about and tie it together, what opportunities should we be thinking about going into the next year?
Yeah, one specific opportunity I would point to first is in the world of alternative investments. It's a market segment that's become more and more utilized by nonprofits, you know, over probably the past 10 to 15 years. At first, mostly concentrated with larger endowments and organizations, but more recently becoming more accessible and utilized by smaller and mid-sized organizations as well. Even though alternatives are sort of discussed under one blanket term, they're actually extremely diverse in terms of, you know, kind of the characteristics of the various asset classes that are considered alternatives. So for example, you have something like private debt, private credit on one end of the spectrum that can often provide very reliable sources of income, as well as do a pretty good job at preserving invested capital. And then on the other end of the spectrum, you have things like private equity, hedge funds that are often much more growth oriented, total return oriented, that often come with a greater degree of volatility risk associated with them as well. So I think there's a lot of education that can be done for boards and investment committees around, you know, really what alternatives are, and if they might make sense for an organization to consider. To be clear, though, these types of asset classes and investment vehicles, there aren't going to be for every investor. There are clear trade-offs that need to be considered when thinking about all these things. They often come with diversification benefits, greater returns in certain instances, differentiated sources of income, like I mentioned. But in exchange, there are typically higher fees, different types of qualification standards to be able to invest in some of these vehicles, and especially oftentimes lesser liquidity and lesser transparency into the investments and the holdings themselves, that come along with many of these alternative asset classes as well. So I think there's certainly a prime opportunity for an organization to do some due diligence or refresh their due diligence on the alternative space in general, and maybe dig into some of the nuances of the different types of asset classes that fall under this broad umbrella. But while keeping in mind, those trade-offs that I mentioned, and being very discerning in this process about what may make sense for the organization's specific situation and goals.
Yeah, I have a disclaimer when someone asks me for a prediction. I say over 1 year, anything can happen. Over the longer term, though, there is a stronger relationship between things like the starting point where we are today and things like yields on bonds and the starting valuation in the stock market. There's a stronger relationship between the starting point today and the future return. So basically anything can happen this year, but over the next 10 years or so, the math looks a little difficult. And I think that's one of the reasons why Paul and I, talked about, or we are talking about alternatives in some cases to make that math work a little bit better. So item number one is based on starting conditions today, I'd be planning for lower than average stock returns, for bond returns that are closer to the 10-year yield of about 4% today, and for inflation to be on the higher side. So we're using 3% for a planning number for inflation. The Fed targets about 2%, just for context. We could continue to see higher inflation over the longer term. It doesn't even have to have anything to do with COVID or supply chains. It's just some larger picture secular trends that are mostly driving that. It's fewer workers, it's less globalization, and it's less capital investments. Those are all structural factors that could lead to higher inflation over a long time period, at least relative to what we're used to in the 2010s when we were sub 2%. I would make an initiative to make sure you're all accounting for inflation in your policies, and to make sure that you're managing the risk of lost purchasing power when you're planning for your endowment. And so that's sort of another recommendation. And then finally, as far as just really general planning is concerned, it used to be like the plan that you'd have or the policy. I think an opportunity moving forward will be ongoing planning. Typically, you want to have a fresh look every year. It doesn't mean things have to change, but you should be reevaluating your policy each year in light of current conditions, current spending needs, and inflation. Again, that's my wheelhouse. We help our clients do just that. And so don't feel like you're alone in trying to navigate change.
Yeah, and the same goes for our donors, Nick. We evaluate that stuff for them every year. And I mean, I also think that donors kind of have a short attention span or don't really remember things all that well year to year. So I will say another important part of gathering the donations is reminding donors to make them and how. So for example, we reach out to our clients around the beginning of the year to tell them. I touched on QCDs, or qualified charitable distributions, from IRAs earlier. They get notified of the amount at the start of the year. It's top of their mind. So maybe it's a good time to send out an email campaign reminding them of all the great tax benefits of donating directly from an IRA. End of year, maybe like August, September is a good time to start thinking about their income tax situation for the year, kind of reviewing their portfolio, seeing if they have highly appreciated stock that they want to gift or something like that. And then another thing that a surprising amount of donors don't really think about is that they can name charities in their wills, trusts, and as IRA beneficiaries. So that's something that can always be, discussed with them or just like reminded. I think, Nick, we gave a talk a few years ago to a group of donors of one of our clients, and we got an email after saying like, oh, I never thought to put it in my will. So, and we had another client receive a large bequest because one of our donors actually ended up adding them to their wills just because we reminded them to. So I think it's continuous education and, your own staff being familiar with the different ways. And we do have a lot of resources here at Manning to kind of help with that. We have a ton of materials for our donors that we are obviously happy to share with you for you to pass along or use for your own staff's needs.
Yeah, and something like that, it requires no immediate cash outlay. And so again, like the current environment matters. It doesn't matter whether someone will give, but how. And so if you think the time is right, the time isn't right for, asking for a direct major gift, perhaps it is right to start cultivating a legacy gift where there is no immediate cash outlay. So that's just one example of, I think, a useful aspect of some of this market environment that we're talking about.
All right, well, this marks the end of our prepared remarks for today. But if you have any specific questions for our panelists, feel free to add them in the Q&A box at the bottom of your screen, or you can reach out to us directly after the webinar. We have included a link to a survey in the chat, and we really appreciate any feedback that you have about our speakers and the content for today. So the survey is also going to automatically pop up at the end of the webinar. So if you don't get to the link, you will still see that come in. And at this time, we can begin answering some of the questions that have come in. Nick, I am going to direct this first question to you. The move investments to cash scare of a year ago must have repercussions for giving trends and for investment advice today. Can you comment on this?
Yeah. I guess number one, a return on cash is great, but beware of reinvestment rate risk. So again, that was some of what Paul was talking about. Is it better to earn 5% on your cash and be guaranteed that amount for 3 months? Or is it better to earn 4% on your longer term money and be guaranteed that amount for 5 years plus? So that's a judgment that has a lot of weight, because if you're over allocated to cash, that doesn't necessarily align well with your liabilities. And like, speaking of liabilities, like aligning your liabilities with your assets, to sort of borrow a concept from the pension world, you as an organization have some liabilities that are very short term, and cash is great for that, for meeting those liabilities. But you have other liabilities, i.e. spending, that's much longer term, and you really need growth to meet those longer term liabilities. And so that's where you do need to consider cash relative to bonds, relative to stocks. They all play a little bit of a different role in funding the timing of those different spending needs, i.e. liabilities that you have. And the last thing is we did mention sort of higher rates on cash being sort of a mixed bag for donors, helping some, hurting others. But know that as well. It's not an easy one-to-one rule of thumb relationship that we can make to say that higher returns on cash will help or hurt donors.
I am going to direct our second question to you, Paul. Should we be concerned about the national debt?
Well, the short answer would probably be that some amount of concern is likely warranted. But maybe not to quite the degree that many think or feel. At the end of the day, there's not really any specific, line in the sand where the national debt necessarily becomes too large all of a sudden or creates an imminent systemic risk. There's been some element of worry in various circles that around kind of other global powers asserting themselves. But when it comes to debt relative to GDP, at least, a lot of other major economies actually have greater debt ratios than the US does. Japan, the UK, France, Canada, several others that relative to the growth of the economy, especially, and that's very crucial because the US does continue to enjoy, a higher growth rate than most other nations around the world, especially developed nations. And that is a big part of the equation when you talk about this stuff. There's been a pretty good amount of ink spilled around the dollar's weakening place in the world potentially. And that can be associated sort of with the US as a whole. And for a while now, there's been incremental movement toward other currencies, taking a more prominent role in the global economy. But the dollar remains, far and away the dominant currency. And that we don't think that's likely to change to a large degree in the foreseeable future. So that's all to reinforce sort of that the national debt per se, we don't think is an imminent risk to the US, but if you look further out over the long term, there is probably some reason for concern in the form of something specific we would think about would be potentially higher long-term inflation, like Nick mentioned earlier. And like he said, it's not necessarily similar to like the acute bout of supply shock, pandemic response inflation that we had for the last couple of years, but rather a more sustained condition of, moderately higher inflation, closer to that 3% range potentially, which can have a lot of implications in and of itself. And we think it's certainly within the realm of possibility looking forward over the medium to long term, and definitely something we're keeping a close eye on, in the years to come, as far as something specific that may be a byproduct of continuously of a continuously increasing national debt situation.
I agree with all that, and I can maybe add a little bit about how, like the processes that we use to build portfolios. Theory holds that rising debt reduces investment, it slows growth, it increases inflation expectations, which in kind of like a self-fulfilling prophecy kind of way can lead to higher inflation itself. And then it also reduces confidence in the dollar, which makes us poorer, which makes things more expensive. So there's absolutely no line in the sand where we all of a sudden, debt becomes a big issue. But it is a major long-term risk that all investors have to consider, including endowments. When we build portfolios, we use a combination of top-down and bottom-up input. So our top-down groups all have opinions on debt, the dollar, GDP growth, inflation, all these big picture things that informs our bottom-up analysts to help them with which stocks to pick. So I think it's a benefit to managing these longer-term secular risks that Paul is mentioning, like our national debt, is having that flexibility in your process. There will be winners and losers, and endowments need the flexibility just to manage these risks as best they can.
All right, well, that was actually the last of our submitted questions for today. But if you have any questions about anything we discussed today, please don't hesitate to contact us, and we will get back to you over the next few days. As I mentioned earlier, a recording of this event will be available on our website within the next several business days. As a reminder, our endowments and foundations team is here to help you and your organization achieve your goals. So we can help with portfolio evaluations, investment policy statements, and we can also help educate your board and staff on topics that will help you succeed. We really strive to be a continued resource to our nonprofit partners because you are the ones that are truly doing the work to make our community a better place. So our team provides a number of resources that includes blog posts, webinars, and other thought leadership. All of this can be found on our Insights for Nonprofits site. So if you are not already subscribed, feel free to sign up to receive these complimentary resources using the link that we have right here on this slide, and it's also been dropped in the chat. And if you're interested in discussing how we can help support your organization's goals this year, please don't hesitate to schedule a call with us. We'd love to hear from you. Thank you so much to our speakers, Nick, Margaret, and Paul, and thank you all for attending today. Have a wonderful rest of your day.
Thanks, everyone.
Thank you.